Corporate bankruptcies have officially hit their highest levels since 2010, signaling that the era of easy money is dead and a massive reckoning is here.
George Gammon of Rebel Capitalist warns that 20% of U.S. companies are now zombies, unable to survive without more debt. And he is joined by macro experts like Bubba Horwitz and technical analyst Chris Vermeulen.
We've used advanced AI to compress hours of these high-level macro discussions into just minutes of actionable insights, saving you time while keeping you ahead of the curve.
You will discover why a 100% margin call is looming, and which specific asset is predicted to go parabolic, even if the S&P 500 crashes 40%.
Let's jump straight into George Gammon's viral report on the $2.5 trillion debt cliff that starts the domino effect. The main takeaway from George Gammon's latest report is terrifying. Corporate bankruptcies have officially hit their highest levels since 2010.
Exactly. George is highlighting that the easy money era is dead. Companies that survived on 0% interest rates are finally hitting a wall.
Wait, highest since 2010? That's the great financial crisis territory. Are we actually back there?
According to George, we might be. While the stock market looks shiny, the foundation of corporate debt is crumbling underneath it.
George Gammon's analysis shows that the Fed keeping rates high isn't just a headline, it's a death sentence for zombie companies.
Right. And while these bankruptcies are the big story now, wait until we see what happens to the $2.5 trillion maturity wall hitting next year.
Maturity wall? Sounds like a bad action movie. What does that actually mean for my bank account?
It means companies have to refinance old, cheap debt at today's massive rates. If they can't, they go bust. That's the open loop George is watching.
George Gammon's core thesis revolves around this $2.5 trillion debt cliff. It's the moment of truth for the U.S. economy.
Think of it like a homeowner who had a 2% mortgage that suddenly jumps to 8%. Most businesses simply haven't budgeted for that.
Hold on, 2.5 trillion. That's a lot of zeros. How many companies are we talking about here?
Thousands. George notes that many of these are large employers, not just tiny startups.
So if they can't pay the interest, they start cutting jobs or shutting doors entirely. George points out that roughly 20% of U.S. companies are zombies, meaning they don't make enough profit to cover their debt interest.
They've stayed alive by just borrowing more money to pay the interest on the old money. It's a giant Ponzi scheme of corporate debt.
Wait, 1 in 5. So 20% of the mall is basically a ghost town in waiting.
Pretty much. And with rates staying high, the bank is finally saying no to the new loans.
George calls this the reckoning phase. No more free lunch.
A huge part of George Gammon's argument is the lag effect. Rate hikes take 12 to 18 months to actually break things.
Right. Everyone thought we dodged a bullet in 2023. But George says we're only now feeling the impact of the initial hikes.
So it's like a hangover that doesn't hit until the next afternoon.
Perfect analogy. The Fed drank the high-rate tequila a year ago, and the economy is just starting to get the headache.
And the data is finally reflecting it with these viral bankruptcy numbers. George is particularly worried about regional banks, who hold about 60% of all commercial real estate debt.
When those corporate bankruptcies happen, the buildings go back to the banks. But if the building is worth half what it was, the bank is in trouble.
So if the company goes bust, the bank goes bust too. That sounds like a domino effect.
That's exactly George's point. It's a systemic risk that hasn't been priced into the market yet.
It's 2023's banking crisis, but part 2 and potentially much bigger. George predicts that as these bankruptcies accelerate, we'll see unemployment jump toward 5.5%.
It's a lagging indicator. Companies try to cut everything else first, but eventually they have to let people go to stay afloat.
5.5%? That's millions of people out of work. Isn't the Fed supposed to prevent that?
George argues the Fed's hands are tied by inflation. They can't just cut rates without making prices spike again.
So we're headed for a hard landing, even if the mainstream media says otherwise. George's second big prediction is a massive credit crunch. Banks are going to stop lending to everyone but the most perfect borrowers.
Wait, so even if I have good credit, I might not get a car loan or a mortgage?
Exactly. George notes that lending standards could tighten by 40% as banks try to protect their own balance sheets.
When the credit faucet turns off, the economy grinds to a halt. That's the GFC 2.0 George is warning about.
George Gammon suggests keeping a hawkeye on the 10-year Treasury yield as the ultimate stress test.
If it stays high while bankruptcies rise, it means the market is losing confidence in the Fed's ability to fix this.
So high yields equal high danger. Got it.
Precisely. It's the canary in the coal mine for the entire debt system.
George's practical advice: liquidity is king. He recommends holding at least 10% more cash than usual.
Wait, so I should stop buying stocks and just keep cash?
In George's view, cash gives you the power to buy assets when they're on sale during the crash.
Exactly. You don't want to be the one forced to sell. You want to be the one with the cash to buy.
Today, we're breaking down a brutal market session with insights from Bubba Horwitz and Michelle McCory. Bubba's saying this isn't just a dip, it is a 100% margin call.
Exactly. When big players get over-leveraged and the market turns, they're forced to sell everything that isn't nailed down to cover their losses.
Wait, so you're telling me people are selling gold just because their tech stocks crashed?
That's exactly it. In a liquidation event, you don't sell what you want to sell, you sell what you can sell.
Bubba's point is that the usual rules of diversification go out the window when the margin man comes knocking.
Right. Which explains why gold, silver, and tech are all bleeding at the same time. But hold on, while the panic is real, Bubba sees a floor for one specific asset that will hit in a minute.
A floor? I hope it's made of actual gold, because my portfolio looks like a basement right now.
We'll get to that buying opportunity soon, but first, we need to understand why the US dollar is acting like a wrecking ball.
Bubba Horwitz explains that a 100% margin call means the brokers are demanding total collateral, forcing immediate sales across all asset classes.
It's a domino effect. One big fund gets hit, they sell gold to cover tech, which drives gold down, triggering the next guy's margin call.
So it's like a financial pileup on the highway. Everyone's just crashing into each other.
That's a perfect analogy. And when the dust settles, the only thing left standing is often the US dollar.
According to Bubba, the strength of the US dollar is a primary driver for the carnage we're seeing in commodities.
Since gold and silver are priced in dollars, when the greenback spikes, these metals naturally become more expensive for international buyers, suppressing demand.
So, a strong dollar is actually bad for my silver stash. I thought the dollar was supposed to be weak for gold to go up.
Usually, yes. But right now, the dollar is the only life raft in a stormy sea. And that's crushing everything else. In his talk with Michelle McCory, Bubba points out that gold is being used as a literal ATM to fund losses elsewhere.
It's ironic. The safest asset in the world is being dumped because it's the only thing people have that still has value.
Wait, so gold isn't failing as a hedge? It's just too good at its job?
Precisely. It's the most liquid asset, so it's the first thing you sell when you need cash fast.
Bubba notes that the Nasdaq's recent run-up was built on massive leverage, which is now unwinding rapidly.
We've seen tech names drop 10% or more in a blink. When the leverage disappears, the valuation floor vanishes too.
10%? That's a lot of money disappearing from 401ks.
It is, and Bubba warns that until the margin calls stop, there's no reason to think tech is safe yet.
Bubba Horwitz predicts that gold will eventually find a firm floor around the $1,800 mark once the forced selling ends.
That's a significant drop from the highs, but he thinks that's where the real buyers will step back in.
1,800? That sounds like a bargain if the world is still ending, right?
It could be. Bubba suggests that the fundamentals for gold haven't changed, only the technical need for cash has.
Bubba's longer-term outlook is quite bearish, suggesting this volatility is a precursor to a 12-month recession.
He believes the Fed's actions and the current market structure are practically guaranteeing a hard landing.
A whole year of this? I'm going to need a lot more coffee and a lot less looking at my bank account.
Buckle up, because Bubba thinks the real economic pain is only just starting to show up in the data. The main takeaway from Bubba Horwitz is to keep a very close eye on the US dollar index.
Exactly. If the DXY continues to climb, commodities will continue to struggle. Cash is your best friend during a margin call.
So, keep my powder dry and wait for the forced sellers to finish their panic.
Precisely. Don't try to catch a falling knife. Wait for the margin calls to clear out the weak hands.
Bubba also warns against using leverage yourself right now. That's how people get wiped out in these cycles.
Note taken. No more gambling with money I don't have. Seems like a solid life lesson.
It's the only way to survive a 100% margin call event. Stay disciplined.
And stay tuned, because as Michelle McCory and Bubba highlighted, this market is moving faster than ever. Today, we're dissecting the critical market reaction to the CPI inflation report, specifically looking at the technical levels provided by Matt DeWolf from Trade Brigade.
Matt spent the morning tracking the pre-market action, and honestly, the move we saw after the numbers dropped was nothing short of a vertical liftoff.
Wait, liftoff? Are we talking about inflation going up, or the stocks?
Stocks, mostly, because Matt points out that the inflation data actually came in colder than anyone expected.
The headline number was 3.3% year over year, which beat the 3.4% expectation. That's the alpha here. Inflation is cooling faster than the pros predicted.
3.3%? That sounds small, but I guess in the stock world, that's a massive deal.
It's huge. But hold on. Matt DeWolf warns that while we're mooning now, the Fed meeting later this afternoon could easily pull the rug out from under this rally.
Exactly. We've got a gap-and-go situation on the S&P 500, but the FOMC announcement is the second half of this doubleheader.
Matt DeWolf highlights the most shocking stat. Monthly inflation was exactly 0.0%.
Right. The market was bracing for 0.1% growth. Seeing a flat zero triggered an immediate short squeeze in the S&P and Nasdaq.
Hold up. 0%? So prices didn't go up at all last month?
On average, yeah. And Matt notes that this is exactly what the bulls needed to see to justify these all-time highs.
It's a relief rally, but it's fueled by cold hard data for once.
Looking at Matt DeWolf's charts, the E-mini S&P 500 cleared the 5,450 level, like it wasn't even there.
He's watching that 5,500 level now. It's a massive psychological magnet for the bulls.
So, if it hits 5,500, does everyone just sell and go home?
Maybe. Matt suggests that since we're in price discovery mode at all-time highs, there's no overhead resistance. It's blue skies from here.
We also saw a massive move in bonds. The 10-year yield plummeted below 4.3% almost instantly.
Matt DeWolf argues this is the real engine behind the Nasdaq rally. Lower yields mean higher valuations for those big tech stocks.
Wait, yields go down, tech goes up. Why is that?
It's about the cost of borrowing and how we value future earnings. Basically, it makes growth look much more attractive.
And Matt points out that Nvidia and Apple are leading the charge because of this yield drop.
Core CPI, which strips out food and energy, came in at 3.4%.
Matt notes this is still above the Fed's 2% target. But the trend is clearly heading in the right direction.
3.4% still feels higher than 2. Are we celebrating too early?
Matt's analysis suggests the market cares more about the delta, the change, than the absolute number right now. It's slowing down, and that's what matters.
Matt DeWolf is bracing for a two-sided day. He predicts the initial CPI euphoria might get tested when Jerome Powell speaks at 2 p.m.
Exactly. If Powell comes out hawkish and says don't get excited, no rate cuts yet, we could see a fade of this entire morning move.
So we could gain all this money in the morning and lose it by dinner?
In this market? Absolutely. Matt's advice is to protect profits before the Fed takes the stage.
It's a classic sell the news risk.
Matt predicts the Nasdaq will continue to outpace the S&P if the 10-year yield stays under 4.3%.
He's looking at the 19,500 level on the NQ as the next major target.
19,500? Man, these numbers just keep going up.
As long as inflation stays cold, Matt's charts suggest there's no reason to fight the trend.
Matt DeWolf's main takeaway? Use 5,450 as your line in the sand.
If we drop back below that, the CPI breakout is a fake out. Stay above it, and the trend is your friend.
Line in the sand. Got it. So if it breaks, I run?
According to Matt's technicals, that would be the signal to get defensive.
Finally, Matt says to watch the dollar index. It tanked on the CPI news, which is great for stocks.
But if the dollar starts bouncing back, it'll act like a vacuum, sucking the life out of this stock rally.
So a weak dollar is good for my portfolio. This is all backwards.
Welcome to macroeconomics. It's weird, but following Matt's levels makes it a lot less scary.
We are looking at a massive warning from Chris Vermeulen of TheTechnicalTraders. He is seeing technical patterns that suggest a 30 to 40% market crash could be starting right now.
Chris points to the exhaustion in the current rally. The technicals show we are moving from a growth phase into a dangerous topping phase.
Wait, 30 to 40%? That's not a correction. That's a total meltdown of my retirement account.
Exactly, which is why Chris says protecting your capital is the only priority today. But stick around, because while stocks might tank, he sees one specific asset class that is about to go parabolic. Chris Vermeulen's core thesis is that we've entered stage 3. What does that actually mean for the S&P 500?
Well, Chris explains that stage 2 is the easy money uptrend. Stage 3 is when the big institutions start quietly selling to retail investors while prices move sideways.
So it's like a game of musical chairs, and the music just stopped.
Precisely. The volatility spikes, but the price isn't making new highs anymore. It's the distribution phase before the floor drops out.
And Chris notes that this specific pattern looks eerily similar to the peaks we saw in 2002, 2008. Chris is particularly worried about the tech-heavy Nasdaq. He says the A-driven surge has pushed valuations to unsustainable levels.
Right. He mentions that the top 7 stocks have been doing all the heavy lifting, but now even they are starting to look tired.
So if the Magnificent Seven stop running, the whole index just falls over.
That is the risk Chris is highlighting. When leadership fails, the rest of the market usually follows pretty quickly.
According to Chris Vermeulen, the smart money is rotating out of equities and into precious metals.
He is very bullish on gold, suggesting it could hit $2,700 an ounce as this volatility increases.
Wait, if everything is crashing, why would gold go up? Isn't everything supposed to go down in a crash?
Usually, yes, in the initial panic. But Chris points out that gold is the ultimate hedge when trust in the financial system or the dollar starts to wobble.
He also noted that silver is looking for a breakout above $30, which would be a massive signal for a commodities bull run.
Chris has identified 5,200 as the line in the sand for the S&P 500.
If we close below that level, Chris warns that the technical waterfall begins.
A waterfall? That sounds wet and terrifying.
It means the selling accelerates because there are no buyers left at those prices. Everyone rushes for the exit at once.
Chris Vermeulen isn't just predicting a quick dip. He thinks this bear market could drag on for 6 to 12 months.
His reasoning is based on the size of the previous rally. The bigger the climb, the longer the digestion period needs to be.
So I should probably get used to seeing red in my account for a while?
If Chris is right, the buy the dip strategy is going to be very painful for at least a year.
Here is the silver lining. Chris predicts that mining stocks, specifically the GDX and GDXJ, could actually gain 50% while the rest of the market tanks.
It's a leverage play. If gold goes up 10%, the miners often move 2 or 3 times that much.
50% gains while the S&P is down 40. Now you're talking my language.
It's about being in the right sector at the right time, and Chris thinks that time for miners is coming very soon. Chris Vermeulen's final takeaway is simple. Raise cash and use stop losses.
Don't let a 20% correction turn into a 40% life-changing loss. Exit the positions that are breaking their trends.
So, basically, don't be a hero. If the chart looks broken, just get out.
Exactly. Chris emphasizes that you can't buy the eventual bottom if you don't have any cash left to trade with.
Watch those moving averages. Watch the 5,200 level on the S&P and stay defensive.
Today we are breaking down the credit cycle with insights from Jeff Snider, the head of research at Eurodollar University.
Jeff Snider argues that what the Federal Reserve does matters way less than the hidden plumbing of the global credit system.
Wait, did you just say the Fed doesn't matter? That's basically heresy on Wall Street.
Exactly. Snider's whole thesis is that private banks create the money, and right now, they are slamming the brakes.
So, while everyone watches interest rates, Jeff Snider is watching the actual pipes where the money flows.
According to Jeff Snider's analysis, we have moved past the peak and are firmly in a contractionary phase of the credit cycle.
And the scary part is that this contraction is happening in the shadow banking system, where there's no safety net.
Shadow banking? That sounds like something out of a spy novel. Are we talking about secret underground vaults?
Not quite. It is the Eurodollar market. Jeff Snider notes it is essentially a ledger system between global banks that operates without central bank oversight.
And when those banks stop trusting each other, the global economy starves for liquidity. Jeff Snider points out that banks are tightening lending standards at an aggressive pace.
Right. And he emphasizes that they aren't doing this because of the Fed. They're doing it because they see rising risk on their own balance sheets.
So it's like a bank telling you no, even if you offer to pay 100% interest?
Precisely. When banks are scared, price doesn't matter. Availability does. Jeff Snider calls this a silent liquidity squeeze.
It's the difference between a high price for a car and the car simply not being for sale.
A major part of Snider's discussion focuses on collateral, specifically pristine assets like U.S. treasuries.
If there aren't enough good treasuries to go around, the whole repo market stalls.
Wait, how can there be a shortage of treasuries? Doesn't the government print those like crazy?
They do, but Jeff Snider explains that the demand for them as collateral for complex trades is even higher than the supply.
So, when the system gets thirsty for safety, everyone grabs the same limited number of life vests at once.
And I'm guessing there aren't enough life vests for everyone.
Jeff Snider highlights that what happens in the Eurodollar market in London eventually hits small businesses in the Midwest.
It's a global ripple effect. If a bank in Japan can't get dollars, they stop lending to companies everywhere.
So my local pizza shop could struggle because of a banking hiccup across the ocean.
Exactly. Snider's data shows that these global dollar shortages precede almost every major economic downturn.
It's the ultimate lead indicator that most people ignore because it's too complicated. Jeff Snider's outlook isn't exactly sunshine and rainbows. He's predicting a long period of stagnation.
He expects a L-shaped recovery or even a further slide because the credit engine is broken.
An L shape? So we just go down and stay there?
Pretty much. Without credit growth, you can't have real economic growth.
According to Snider, we've been in a version of this since 2008, and it's only getting tighter. Jeff Snider points to the deep inversion of the yield curve as a massive red flag for the next 12 months.
The bond market is essentially screaming that something is wrong with future growth.
I always hear about the yield curve. Is it actually right this time?
Jeff Snider says the bond market has a much better track record than the Fed. It has predicted every recession for decades.
And right now, it's predicting a significant deflationary event. So how do we watch this ourselves? Jeff Snider suggests keeping an eye on the SLOOS report.
That's the Senior Loan Officer Opinion Survey. It tells you exactly how much banks are tightening.
The SLOOS? Sounds like something I'd find in a swamp, but okay.
It's actually very clean data. If those numbers keep rising, credit is drying up.
Finally, Jeff Snider says to watch credit spreads, the difference between safe and risky debt.
If spreads widen, it means the market is panicking about defaults.
So if the gap gets bigger, my stocks are probably in trouble.
Usually, yes. It's the market's way of saying, I'm out.
As Jeff Snider often says, the signals are all there if you know which pipes to look at.
David Hay is sounding the alarm, warning that we are on the verge of a vicious unwind in the stock market, specifically targeting the tech giants that have been carrying the entire index.
Exactly. During his discussion with David Lin, Hay pointed out that the concentration in just a few names has reached a fever pitch, making the eventual drop much more painful.
Wait, vicious is a strong word. Are we talking about a total market crash, or just a bad month for my tech stocks?
Hay suggests it's the latter that triggers the former. If the top 7 names stumble, the whole S&P 500 goes down with them.
The core insight here is that while tech looks like a bubble, David Hay believes sectors like energy and commodities are actually undervalued and ready to surge.
Right. It's a massive rotation. But hold that thought. We're going to look at the specific commodity Hay says is a must-own for the next decade in just a few minutes.
So, sell the shiny tech stuff and buy oil and dirt? That sounds like a tough sell for most people.
It is, until the shiny stuff drops 20% and the dirt keeps its value.
David Hay's main thesis revolves around concentration risk. Did you know the top 7 tech stocks now represent nearly 30% of the entire S&P 500?
It's unprecedented. Hay argues that investors aren't buying a diversified market anymore. They're essentially gambling on 7 companies to keep growing forever.
30%? That's like a basketball team where one guy takes all the shots. If he twists an ankle, the game is over.
That is a perfect analogy. According to David Lin's conversation with Hay, when these giants finally mean revert, the unwind will be brutal for passive index investors.
David Hay points out a massive valuation gap. Energy stocks are trading at 10 to 12 times earnings, while tech is sitting at 30 times or higher.
Wait, so energy is basically on sale, while tech is a luxury brand with a huge markup.
Precisely. Hay believes the smart money is already moving into these unloved sectors, because the risk-to-reward ratio is so much better.
He specifically mentioned that even if the economy slows, we still need energy, but we might not need a new $1,000 phone.
Another pillar of Hay's analysis is the higher for longer interest rate environment. He's watching the 10-year Treasury yield closely.
If that yield stays above 4.5%, tech valuations have to come down. The math just doesn't support high price-to-earnings ratios when you can get 4 or 5% risk-free.
So the government is basically competing with the stock market for my money?
Exactly. And according to David Hay, the government's safe return is starting to look a lot more attractive than overstretched tech stocks.
Hay also highlighted gold. He views it not just as a metal, but as a currency that can't be printed by central banks.
Is gold still relevant? I thought everyone moved to Bitcoin for that.
Hay sticks to the classics. He told David Lin that with the current debt levels, gold is the only insurance policy that has stood the test of thousands of years.
It's about stability. When the vicious unwind hits, gold tends to be the last man standing.
David Hay is predicting a 15 to 20% pullback in the S&P 500, and he expects the Nasdaq to lead the way down.
He argues that we haven't had a real cleansing of the market since the post-pandemic surge, and this unwind is overdue.
20%? That's officially bear market territory. Is there any way out of this?
Only through diversification. Hay's data suggests that while the index drops, value-oriented stocks might actually stay flat or even rise.
Longer term, Hay sees a 3 to 5 year bull market in commodities. He's talking about everything from copper to oil.
He notes that underinvestment in these industries for the last decade has created a supply shortage that will drive prices much higher.
Wait, so as we aren't digging enough copper, and we need it for everything, the price has to go up?
Precisely. Hay thinks this is a multi-year trend that most investors are completely ignoring.
The takeaway from David Hay's analysis is clear. Reduce your exposure to the mega-cap growth names that everyone else is buying.
Instead, look for high-quality value companies and the energy sector. That's where Hay sees the most safety and potential upside.
So, basically, stop following the crowd and start looking at the boring stuff.
In this market, boring is beautiful. Hay's discussion with David Lin emphasizes that preserving capital is just as important as growing it right now.
And finally, keep an eye on that 10-year yield. If it starts to climb significantly past 5%, the tech unwind could happen faster than anyone expects.
I'll be watching the charts. I'd rather be early to the exit than stuck in the vicious crowd.
Smart move. Hay's insights suggest the window to rebalance is closing. First up, David Hay highlights a tricky situation, the concentration crisis, where a handful of companies are pulling all the weight.
Exactly. David argues that this concentration is masking underlying economic weaknesses that could lead to a major fallout.
So, it's like a few big fish in a pond full of dying smaller ones.
That's alarming. Right. A significant topic to keep in mind. Next is Jeff Snider, who emphasizes the shadow money system's impact.
Absolutely. Jeff argues that conventional liquidity measures are misleading, depicting a healthier market than what truly exists.
So he basically says, the money is there, just not in the places we think it is.
Exactly. It's hidden dynamics affecting everyone's finances. Then we have Chris Vermeulen, who's introducing a cautionary tale. He stands by the idea that we are in a topping phase.
Correct. Chris believes that we are on the verge of a market correction as the excitement fades.
So he thinks it's time to brace for impact? That sounds intense.
Indeed, it indicates a shift in the market's health. Matt DeWolf rounds out our discussion by addressing inflation. He suggests the trends might not follow the usual patterns.
Yes, Matt is saying that inflation isn't an open and shut case. It might actually cool down unexpectedly.
So, we're not as doomed as it seems with inflation. That's a relief.
Exactly. It's a nuanced perspective that counters the prevailing fear. Lastly, Bubba Horwitz discusses forced liquidations and how they could spiral out of control.
His argument is that as companies start to fail, it could trigger a chain reaction, leading to major market losses.
So, it's like a domino effect, waiting to happen.
Spot on. Understanding this dynamic is crucial for anticipating market movements. Interestingly, all our guests converge on this point. The financial system is straining.
Right. They might approach it from different angles, but all agree that we're heading toward changes, and not the pleasant kind.
So it's not just one person shouting fire in a crowded theater. Everyone's in the same boat.
Indeed, their collective concern reflects a more serious reality. David and Jeff both touch on the idea that there's a lot we can't see about the financial system.
That's right. They highlight hidden risks that traditional metrics fail to capture.
So, they're saying all that healthy talk could just be a smokescreen?
Exactly. Important to look deeper. Chris and Bubba are in sync regarding external pressures causing market instability.
Absolutely. They both warn that market corrections stem not only from internal metrics, but also from broader economic shifts.
So it's like they're both spotting a storm coming, just from different radars.
Spot on. Their solutions may differ, but they see the impending turbulence. Here's where the rubber meets the road. David argues for potential intervention to stabilize the market.
In contrast, Jeff insists that these are structural issues requiring reform, not quick fixes.
Wait, so David wants action, and Jeff thinks we should let it run its course.
Exactly. David sees urgency, while Jeff trusts inherent market corrections. Now, Bubba and Chris have a fundamental disagreement about how to interpret liquidation risks.
Right. Bubba warns that immediate liquidations could cause chaos, while Chris believes we're still stabilizing.
So, one sees the glass half empty, the other sees it half full.
Precisely. That difference in outlook is crucial for investors to understand. And that wraps up our deep dive into these crucial financial insights.
If you found this breakdown valuable, don't forget to like, subscribe, and share with your friends.
Trust me, I'm not going back to just scrolling. This is a goldmine.
Stay tuned for more expert roundups. It's your go-to source for financial wisdom.